The stock market has been on a tear, rising over 16% in 2025, but at the same time, a powerful economic indicator has been crashing to lows not seen since the 2008 financial crisis. The last two times this indicator collapsed so dramatically, it didn't bode well for the stock market. Look here, it fell off a cliff in 2006, more than a full year before the great financial crisis took hold. And in 2000, it also turned sharply downwards before the dot-com bubble burst. And today, this indicator has been in near free fall since 2022, but the stock market is still climbing higher and higher. So this strong indicator of impending recession is flashing a warning in a market that seems to be ignoring it. The question is whether the indicator is wrong this time or if a major correction is still on its way. This indicator is a ratio between the leading economic index, LEI, and the Coincident Economic Index, CEI. You can think of it as a comparison between the economy we expect to have and the economy we currently have. Here they are separately. The leading index is the forward-looking barometer. It tracks 10 parts of the economy that tend to change first, including the S&P 500, new building permits, and credit. It gives a good idea of where the economy might be heading. The Coincident Index measures what's actually happening right now. It's the rearview mirror. Its components include employment, income, sales, and production. Combining them tells us whether expectations for the economy are deteriorating faster than the current outlook. When this ratio falls, like we've seen it do since 2021, the early warning factors are collapsing much faster than the actual current numbers, like the number of people who have jobs today. Today, the CEI components look strong. Initial jobless claims are low and relatively flat since 2022, signaling a strong labor market. The unemployment rate has been ticking up since 2023, but it's still only at 4.6%, still within the range considered full employment by the Fed. On top of that, real personal income growth is rising, indicating that consumers are growing their wealth, supporting current spending. Therefore, the current state of the economy, the CEI, is resilient. But this stability in today's numbers is being completely undermined by the LEI. The quick drop in the ratio tells us that the stuff that keeps growth going has begun drying up, even though today's job market might still look pretty good. Historically, when the leading index is this weak compared to the Coincident Index, a big slowdown follows. There's been a noticeable decline in the ISM Purchasing Managers Index, which has been driving the LEI down. This measures economic activity across the manufacturing sector, and it's fallen quite a bit since its post-pandemic peak. New building permits have also been on the decline since its peak in early 2022. This is a key leading indicator for the economy, and it's telling us that developers are pulling back on construction, which in turn reduces demand for building materials and real estate investment. It's a signal of a risk-averse attitude towards the economy ahead. It gets even more convincing when you look at the bond market. If we overlay our ratio with the inverted yield curve, you see both warning signals, the markets and the datas, flashing the same red light at the same time. Historically, an uninversion of the yield curve like this is a classic recession signal. But this time, the policy is different. This isn't just a natural collapse of the business cycle. It's the result of the Federal Reserve intentionally hiking interest rates incredibly fast beginning in spring 2022. The Fed's goal was to slow economic expectations and investment to bring down rampant post-pandemic inflation. Therefore, some of the LEI's weakness, particularly the drop in building permits and the inversion of the yield curve, is an intended consequence of their shock therapy. There are a couple of different explanations for what's going on here. One explanation is that this huge drop in the ratio is caused by the Fed's unprecedented rate hike in 2022, not because the underlying economy is actually broken. This would mean that even though we've seen a huge drop in the ratio, the Fed could achieve a so-called soft landing and avoid a recession as the economy begins to rebalance without catastrophe. For that to happen, the LEI line needs to stop falling and flatten out very soon. That would require the ratio rising back up towards 1, meaning parity between economic expectations and the economy today. If that happens, it would show that future expectations have found their bottom, stabilizing at a lower, non-inflationary level. If the LEI stabilizes before the CEI starts to crash, it implies that the Fed successfully tightened conditions just enough to cool the economy without causing widespread job losses. It's the best case scenario, but there's another possibility here, and that's a recession. For this to play out, the current strong economic numbers, the CEI components like employment and income, must finally crash to meet the plunging expectations of the LEI. In other words, it requires the components of the LEI to trickle down as expected into the rest of the economy and translate from expectation to reality. That would mean the high rates would finally break the labor market, and it depends largely on whether the Fed holds rates steady or continues to cut them as they've been doing. If they hold steady, that makes this outcome more likely. In this case, high rates would force companies to cut jobs and slow hiring, causing initial jobless claims to rise. Resulting job losses would lead to less consumer spending, which causes companies to stop ordering new things and cut hiring even further. And that vicious cycle could lock us into a full-blown recession. The longer the LEI stays at these historic lows without rebounding, the higher the probability that the CEI will eventually collapse to meet it. This ratio has proven itself as a bearish signal before, in 2000 and 2008. There are two possibilities here. Either the signal is wrong this time, and the market could continue to rise despite the collapse in this ratio, or the signal is delayed, in which case we could see a major correction on the horizon as the market gets a reality check. At Capital.com, we'll keep you posted on important economic indicators like this and the latest market news. Hit like and subscribe to stay tuned. Thanks for watching.